Welcome back. You're watching Money, 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 and this week we are encapsulating all the key takeaways from Budget 2018 for you. So, Amit, jog our memory. Are we missing out anything? You did mention standard deduction earlier, but I think the final understanding was that I think now transport allowance, for instance, goes away. So, what is the real benefit, if any?
Yeah, the benefit is very minuscule. You have your medical reimbursement and transport allowance going back, so you hardly get less than 5,000 rupees as the benefit per year. But you have a higher cess, which has gone from 3% to 4%. So you basically end up getting nothing. So the long-term capital gain is definitely going to hit the savings and the retirement corpus of individuals, because we are saving from, we are moving from real estate to financial instruments. One key thing which we have missed, I think, is the stamp duty value. So you earlier, when you had capital gains, the stamp duty value,
when you were selling a property,
your stamp duty value was taken as the sales consideration if your sale consideration was less than that. But in certain cases, when you have house properties which are inside your slightly inside the locality, which don't command the median rates, so then your value was slightly less than the stamp duty value, the actual transaction value. So now they have said if it is within 5% of the stamp duty value, they will allow you to take the actual sales
actual value. So you get that much of sort of a, let's say, discount to the stamp duty rate. As long as it's within 5%.
Yeah, for capital gain purposes.
Okay.
Another thing which has come in, that when you file your tax returns, every return gets mandatorily processed by the tax department under section 143. So any mismatches between your tax credits and your income get added to your income automatically. That was the process which was going on. So you used to get a notice and you had to reply. So that has gone away. So that's a good thing, because we had hundreds of notices getting issued for mismatches of every kind. So I think more than that, I think the biggest change has been the LCCG, which I think we have been discussing.
And no rollbacks, at least as of now. The government isn't promising any kind of a rethink, not immediately. Final thoughts, Mr. Agarwal. I mean, for you, what has been the big takeaway? And, if you look at the next 1 year, does the budget really do anything meaningful, any kind of meaningful change in terms of personal wealth and personal finances?
So in terms of personal finances, means I think all the goodies have been reserved for the senior citizens. So my dad would be a happy man now.
That's
because
the interest, the exemption that you get on bank interest
income, that has gone up from 10,000 to 50,000, and his Mediclaim insurance deduction limit has also actually gone up by from 30,000 to 50,000. And again, no TDS will be deducted on his interest income from bank FD. So these three things are very positive. Standard deduction means not all employees are getting all these transportation allowances or medical reimbursements. So guys like us would be happy with a 40,000 standard deduction. We don't have these medical reimbursement limits. Apart from that, see, one very important development in the budget was government's focus on developing the corporate bond markets. So one, they proposed to launch debt ETFs. So that will bring in much more investable options for a saver, or a financial saver, basically, in the debt space. Second is the government has said that it will mandate the regulators to consider A-rated corporate bonds as investable for certain institutions that are controlled by those regulators, that are regulated by those regulators. So we may see more liquidity flowing in the A-rated corporate bond market. As regards, this LTCG debate has thrown up many other issues, like whether if you should invest in debt funds or equity funds. I think that's again a wrong thing to talk about, because whether you should go for debt or equity depends on your risk appetite.
It's an asset allocation mix. It's your own personal
It depends on your risk appetite. Just because you are getting slightly lower taxes, you can't just go for equities when your investment horizon is 2 years, because equities, you forget about the volatility. So I think these decisions should not be actually based on just incremental post-tax returns.
I take your point. I think the takeaway from our discussion is that be alert, be mindful, do your calculations, look at the changed taxation scenario, but don't jump the gun. Don't be trigger happy. Think about all things and then come down to your investment decisions. Thank you very much, Mr. Agarwal and Amit, for joining us today. Great talking to you as always. That's it on this week's episode of Money, Money, Money. Your feedback, comments, queries, welcome as always. We'll see you again next week.